Very good morning to everyone. Perhaps if I just start with a brief pen portrait of Yorkshire Building Society, for those who aren't familiar with us. We're the second largest building society in the UK. Historically, we've stayed very close to the core activities of a building society, so things we've sort of avoided have been any form of unsecured lending. We didn't buy any mortgage books during the sort of boom years of the mortgage market. We didn't actually lend in the commercial lending market, or indeed even in the buy-to-let market pre-crisis. However, post-crisis, we've actually been very active on the M&A side, and just sort of step through some of those transactions very briefly. In December 2008, we merged with Barnsley Building Society. Barnsley, unfortunately, had some exposures to Icelandic banks, and that sort of precipitated that coming together. More materially, in April 2010, we completed the merger with Chelsea Building Society, and at the time Yorkshire was about a 23 billion asset balance sheet. Chelsea was about 14 billion, so that was quite a transformational merger for us. And actually next month we're due to complete a merger with Norwich and Peterborough, and also the acquisition of the residual part of the egg banking business. So we've been fairly busy. Just a few statistics around the society. We've got about 227 branches by the end of this year, about 90 agencies, about 34 billion of assets under management. And to bring it back to capital, our core capital, Tier 1 core capital ratio was 12.4% at the end of last year. So that sort of M&A background and some of our future growth plans, because we're very much in growth mode, probably makes us quite an interesting case study, capital-wise, looking at it from a Mutual perspective. So what I'll try to do is sort of put some of our experiences and challenges in context as an introduction maybe for the broader debate that hopefully we're going to be having on the use of external capital and some of the issues that are around in the mutual sector at the moment. Since I'm first up, I suppose I should do a real quick noddy's guide of how things have evolved in the building society sector in terms of external capital. In the old regime, we basically had two forms. We had lower tier 2 subordinated debt, and we had tier 1 permanent interest-bearing shares, PIBs, which was a unique tier 1 instrument laid down in legislation that was available to the building society sector. And the key point, really, rather than sort of digging into the kind of tedious legal terms of those instruments, are that there was actually a ready demand for those instruments from the sterling fixed income investor base. And the sector was viewed, as very safe, very secure, and in many ways the mutual model was ideally in sync with the interests of bondholders. So there's a great alignment of interest. Building societies are largely around, or should be around, sustainability, security, long-term business agenda, and not aggressive expansion or short-term profit maximisation. And that fits very well with what a long-term sterling investor wants. And I think probably that's a key requirement going forwards. You really need to look at who you're raising capital from, not just how you're raising it or what particular instruments you're raising it in. So there's no point sort of looking at forms of capital raising if it's coming from flighty sources or ones that aren't committed or prepared to buy and hold, because essentially banking needs long-term commitment of capital. So that was sort of then, and this is now, and sadly and understandably the whole world's changed. Regulators quite rightly are demanding more capital in quantum terms. I think that's probably less of an issue for the mutual sector than it is for the PLC sector, but they're also looking at a focus on core tier 1 capital rather than just tier 1 or tier 2, i.e. they're wanting to increase, quite rightly, the quality of capital. And that's really where the issue, I think, rests for mutuals. Going back to PIBs, which, if you like, was our most equity-like instrument, that will no longer be eligible as tier 1 under the new CRD regime that will be coming into place. That will gradually fall away. And if you look at the market, investors have been hit by a whole series of unfortunate events, such as Bradford and Bingley, where they've seen losses from either instruments being wiped out or forced conversions into more equity-like instruments along the way. And the markets, therefore, like any other wholesale market at the moment, but particularly in capital terms, are effectively frozen. sort of moving back to the regulatory side of life, it's really started from looking at the joint stock share as the benchmark for core tier 1 going forwards. And that obviously raises some quite fundamental issues from a mutual perspective, because it's opening the door to unlimited and profit-related coupons being paid to external stakeholders rather than to members. And given that the core tier 1 PIBS instrument is effectively dead, currently there isn't really an available instrument for building societies or other mutuals to issue. The only core tier 1 eligible instrument has been invented during the crisis, PPDS, and that does tick the boxes for core tier 1 eligibility. So it's perpetual, it's got principal write-down features, it's got a profit-related variable coupon. But in reality, it's only actually been issued once, and that was in a recapitalisation situation with West Bromwich. And it's probably fair to categorise it as a completely unloved financial instrument. It's not really a going concern option or to be used for sort of BAU capital raising as in the old days. So there's no prospect of primary issuance. And the key issue for mutuals is that prospect of unlimited profit sharing to external stakeholders. And from the investor side, it's really the lack of mandate to invest in that type of instrument. They're looking for, if they're holding equity type participation, they're probably looking for more influence over boards. They're interested in liquidity, and these instruments are probably going to be highly illiquid. They're currently unlisted on any stock exchange. And if it's an equity type investment, guess what? They'll probably be looking for an equity type return as well. And that's very hard to equate with the mutual model for fairly obvious reasons. And just to bring it right up to date, there's a lot of good work in progress looking at an instrument with a working title of PLADS at the moment, which is trying to resolve some of those issues. Probably the most important one being putting a restriction or a cap on the coupon amount, so there isn't just an unlimited distribution capability of profits to external stakeholders. But having said that, the jury is very, very much out on whether that's actually a saleable instrument, particularly for the smaller players. So that's sort of the background. If I just briefly sort of step through Yorkshire then and try and sort of link it to some of those issues, I think we're probably quite an interesting case study on how things have evolved on the capital front so far. If you look at our ratios, like many other mutuals, there really aren't any issues in terms of overall quantum of capital, either against the current regime or indeed the future regime as outlined in the recent Vickers report. So core tier 1, 12.4%, overall solvency about 16%. And it's core tier 1 that really matters for future growth, and that therefore is dependent on organic capital generation. And that currently is more than adequate to self-fund the sorts of growth plans that we're looking at. So from our perspective, capital is really only an issue in the event of other inorganic activities, merger type activities, or maybe for replacement of old maturing legacy deals that we've got in the marketplace. And luckily, we don't actually have very many of those. We've got about 100 million of Tier 2, for example. That matures over the next 3 to 13 years. And it's likely that wouldn't get replaced because it really doesn't serve any purpose under the new regime. And probably of more interest is our other two external capital issues. We have 150 million of PIBS outstanding, and we issued the first ever mutual contingent capital note, a COCO, around the time of the Chelsea merger, and that's about 100 million. So if I just start briefly with those, talk about the PIBS maybe. I don't have any slides, as you can see. I didn't know how to illustrate this, so I thought I'd bring it along with me, and it's here. Obviously issued in the days when mutual capital was a much cuddlier thing. And if you read the tombstone, it's 150 million, 5.69%, permanent interest-bearing shares, callable in March 2019, issued in 2006. I call him Bob, for what it's worth. And it's interesting to think about why we issued this. It was really largely around creating a market benchmark and having some market visibility in the wholesale markets, and it was contingency capital. So it wasn't capital that was issued to leverage up growth. And we did the classic thing of issuing capital at a time when the organisation didn't really need it. And it also has to be said, from a Yorkshireman's point of view, it was very, very cheap, as you'd expect. So a couple of observations about Bob here. It's 6 and a bit years until the call date comes up, and a lot can happen in that time. I mean, there's a big debate going on around bail-in debt, so senior unsecured debt that there may be some loss-bearing capability on. Who knows how that pans out over that period? And either way, back to the core tier 1 ratio, that's the one that will drive growth, and PIBS isn't going to be falling into that bucket. So if we had to make that decision tomorrow, the likelihood is we wouldn't be replacing that. The other one is cost. And frankly, I find it very difficult to put an estimate on where current PIBS, if it existed, actually would cost, who knows, 15, 20% type area. The key point is it's uneconomic, and there's no access to the market, and there's a total dislocation between equity risk premia in the external markets and core retail margins. And the sobering thought is that when we issued Bob, fully swapped out, he cost LIBOR plus 100. So that is a permanent first loss-bearing liability on the balance sheet. And currently, if we had to fund in the most secured AAA part of the market, euro-covered bonds, that would probably cost us LIBOR plus 200 fully swapped. So there's a world of difference between those two. So that's sort of the PIB side of life. Just briefly on the cocoa side, it's probably a more interesting case in point because it's evolved during the crisis. And the background was the Chelsea merger. Chelsea had been under some financial stress. It also had some looming funding issues that were coming up, and there was a really great rationale for a merger on both sides. But the issue was capital that potentially stood in the way. At the time, Yorkshire's core tier 1 ratio was about 12, and Chelsea's was just over 8. So there was a natural averaging down in that ratio. But in any merger, you write a very large cheque for fair value adjustments, so effectively marking to market the other business, and all of that comes off capital. And really, it did look like that was going to take the core capital a little too low for comfort, both from a regulatory point of view and also from a rating agency point of view. So Chelsea had about 200 million of outstanding Tier 2 debt, paying about 6%. It was trading in the market at about 30p in the pound, and the solution was to exchange all of that via a bondholder vote into 100 million of new debt issued by Yorkshire, the new entity Yorkshire, 15-year term with a coupon of about 13.5%, but containing a trigger into PPDS if our ratios ever fell to a very low level, 5% in our case. And that had two consequences. One is it created a lot of day one core tier 1, about 126 million, and it also created 100 million of, if you like, proper stress capital, should it ever be needed down the line. So there's a couple of takeaway points there. One is, it was a successful solution to the issue. It did allow the merger to proceed, and it did mean all our ratings remained intact. The bondholders took a haircut, but actually benefited mark-to-market wise. And they also got what they actually wanted, which was a long-dated, high-coupon bond, and actually income-wise, they were back where they started from. And it's also performed since as well, so they've made some money on it. But it was a very, very tricky process to manage. We had all sorts of issues with confidentiality and getting the agreement to exchange the bond before the deal was actually public. We needed a vote of 75% of the bondholders. We had to negotiate between bondholders, regulators, rating agencies, all of those parties wanting slightly different things. And most importantly, from our own side, we wanted to preserve the goodwill of the investor base, going back to my original point of the importance of who you're raising capital from, because we want to go back to them, either to raise debt or even capital going forwards. So they've just lost half the money, and we wanted to make them feel good about it. I'm happy to say I think that's what we've actually achieved. So a few thoughts in summary. There's clearly a long way to go to re-establishing an external capital market for mutuals at the moment. Development of COCOs and PLADs is still work in progress, but it should be a positive step forward. But we have to recognise that currently there's too many unknowns and the market's too distressed for it to be a practical option at the moment. And what's needed is not just new instruments, but also probably a new investor group that will invest in those instruments when they emerge. Thank you very much.